everyone. Let's start discussion on a very important topic, guys, and it is the basics of project finance for the NaBFID Senior Analyst or the analyst role. And it will also help you if you are applying any industry in the infrastructure sector or the the any government body for that's related to the infrastructure finance. So and the project finance. So before we are going to start on the discussion this topic, I would like to request guys, if you are new to my channel and if you are interested in the development financial institutions roles and the senior analyst, analyst role or the business analyst role or the credit risks, market risks analyst role, so please do like and subscribe my channel. So because you will get the new videos and the notification which I am uploading continuously on my channel, and that will definitely help you to get a better opportunity in the better organization with the better salary packages. So let's start discussion. In this video, we are going to discuss on what make project finance is a different from the other finance that provided by the bank for the corporate finance, student loan, or all kinds of role. Then we are going to discuss on some key building blocks that NaBFID analyst should review while working in the project finance at the NaBFID bank. Then we are discussing on very important topic, guys, where we are discussing on the core financial metrics like debt service coverage ratio, loan life coverage ratio, PLCR, project life coverage ratio, IRR, equity IRR, and the break even analysis, how that will do. Then we are going to discuss on the risk framework for in the perspective of NaBFID lens or the infrastructure perspective. We will look what are the risks that in that the project will face, the infrastructure project will face. Then we discuss on some NaBFID specific nuances that you should understand what the new things are going. And then senior analyst appraisal checklist, where we are going to check on the due diligence, model sanity, sensitivity traffic, covenants, and the post disbursement monitoring. Then we are going to look at the red flag to escalate immediately. Once that red flag is occurs, then you need to immediate escalate these things. So that we are going to this thing discuss in this video, guys. So I would like to request you be focused and listen what I am trying to convey you carefully, so you will be understand how the basics of project finance should work. So what makes project finance different? So the project finance are the non-recourse limited recourse, and it is a ring based finance. So repayment from project cash flows, not parent balance sheets and security assets and the contract. So where the non-recourse finance, we are the when we sponsor or when we give loan to the borrower, to that we not give to the balance sheet of that borrower, we will give that the special purpose vehicle of that borrower. So in that case, borrower will create a separate legal entity for that the projects, that government projects like the National Highway Authority of India projects or the Solar Energy Corporation of India projects, or different government, state government, local government body project. So we give them to that sponsor will create a separate entity, and the security is equal to the project assets and the contract amount. So we are not going to cover from their personal assets of the recover of payment. We need to sell their that's the non-recourse financing. That is the first thing you need to understand. The project finance is a non-recourse finance or the limited recourse finance, and that financing will depend on the cash flows of that specific project. So we need to understand how the cash flow will work, what are the traffic risks, revenue risks for that project. So then the second thing, you should understand the special purpose vehicle. The special purpose vehicle is a special legal entity which is formed by the sponsor for that special projects for that project. So if the let's suppose the example of Adani has more than 100,000 projects. So they don't that each project the cash flows or the revenue that not impacted that the balance sheet. So they each project they create a separate entity that they call a special purpose vehicle, and that all the transactions will happen under that special purpose vehicle, and that special purpose vehicle have have itself the one account with the bank, and it is and the legal entity. So in India, that will be registered on the MCA, Ministry of Corporation side, corporate side, and all the legal things will happen for that special purpose vehicle entity. It is and the ring face, and NaBFID directly to special purpose vehicle. So NaBFID directly give loans or the funds or the debt to the special purpose vehicle, not promoted directly, so not give the promoters. And then the project finance in the infrastructure is a long tenure projects. So the tenure of the project is the 15 to 20 years door to door, and NaBFID files the long term debt gap. So the sources of funds are the NaBFID is totally different on the commercial bank side. So there is a NaBFID, there is a no CASA, current account, saving account, fixed deposit, or the recurring deposit kind of thing. So what are their source of funds, where they collect the funds? So their source of fund is a debt market, debenture, bonds. They issue the bonds in the market to collect the funds, or they collect funds from the insurance companies, or the pension funds, or they collect from the intermediaries, other development financial institution, or at the international levels like World Bank, Asian Development Bank, or the Nation Development Bank. So they collect from funds there and apply that funds, or the government spending, government funds they collect, and they invest in the infrastructure projects. So that's the things in the long tenure financing. Because if we take the NaBFID have the CASA account, current account, saving account. So the customers, the savers will save in the CASA balance for the lower duration. It's to 1 year, 2 year, max to max 5 years. And from that 5 years, that's liability. We are not going to provide that funds to the long term, where the funds are get capped. Not, we are not going to cap that fund is get, and we are not going to recover that funds. It's step by step with the in the form of EMIs, monthly EMIs, quarterly EMI, or half annual EMI, where the borrower will give us the principal and the interest rate. So then high capex, long initial cash flow. It's required the huge and huge amount of investment in the infrastructure project. So heavy upfront costs, revenue, post the commercial operation date, moratorium plus structural repayment. So once the that thing will happen, moratorium will give, the structural repayment will happen, the repayment will change, bullion things we will use. So that's what that things makes the project finance is different from the corporate lending or other kinds of finance. So it's depend the other finances depend on the income, or the how the the income of that individual, their balance it. But the project finance will depend on the cash flows of that specific projects, how they generated. So let's move on the next slide, guys, where we are going to discuss on key building blocks NaBFID Senior Analyst review and check while giving the funds to the borrower or the infrastructure project. So the key components are project structure, concerts, cash flow model, revenue model, cost estimation, funding pattern, and the security. And they look for the different NaBFIDs and what it matters for them. So in the project structure, so the project structure, they will look for the special purpose vehicle type of entity. It is a private entity, or the public partnership entity, or it is the trust. So they check what kind of that entity, and the concession. So they check what are the terms and conditions they will define in that the agreement which happen between the government, the sponsor, or the EPC contractor, or the operation and maintenance contractor, or off taker, annuity, or the lender like the NaBFID, and define the risk allocation. What are the risks there? Identify that kind of risks, to do the analysis on that risks, or to take some conclusion on the basis of project structure risks. Then the sponsor. So in that case, the analyst, senior analyst in the NaBFID will need to check for the net worth of the sponsor, track record of the past track record of the sponsor, how they will success rate, timely delivery, how they achieve their milestone, what are the how many projects they are continuously working, equity commitments, how much percentage they want to equity in that project, what are the debt to equity to debt to equity ratio in that project. So that need to be checked and verified thoroughly. And what are the costs needed to the what are the concessions, what are the covenants if the project get delayed, that written by the sponsor, what are the sponsor support in that case, that should to be looked by NaBFID and check thoroughly these things. Then the completion assurance. So there is the NaBFID will always prefer fixed term and the fixed price contract. So there is a completions assurance, how much the assurance they will give. Also they check the assumptions that provided by the sponsor, is that feasible, economical feasible, or the technical feasible, technical viability, that need to be checked in details and analyze that thing. Then the cash flow model. So there are the different cash flow model, like a base, downside cash, break even, or the debt service coverage ratio is a 20-year. So that cash flow model will check by the analysts, review that, do the testing, scenario analysis, sensitivity analysis, where the sensitivity analysis is the analysis where the analyst will take a one by one scenario, like the interest rate hikes, like the operation and maintenance cost will increases, EPC contractor raw material cost is increasing, cost is delay, like the black swan event, like in 2008 crisis, the COVID-19 crisis, or the recently geopolitical event like Iran and UK war, that is affected, how that is affected on the project. So these kind of things we'll do in the sensitivity analysis, and consider all these scenarios we will given you guys in just 2 minutes back. So consider all this scenario and combine this scenario and do the stress testing or the scenario analysis, or all, combination of all the scenarios. Then we do the scenario analysis, and to check the models and determine the debt sizing that required for that project. Then discuss on the revenue model. So what are the revenue model we are going to use for that project? So how the revenue is generated, and how the inflow of the cash will happening from that special purpose vehicle. So then the traffic tariff, what are the tariff we are going to charge, or is that feasible, is that any alternative way to the end user or the customers or the stakeholder that can use to they will avoid to pay the tax. To do that kind of analysis, annuity, it is hybrid annuity model, or the tool based model, or the viability gap funding. It is and the most important, guys. If suppose the project is economical good, but the financial is not good for the project sponsor, and in that case, why the sponsor is, do so huge investment and in the infrastructure project, because of they want to some collect some profit from that project. They want at least 50 to 20% profit of that project. Once they do their analysis and they identify it is not give them the appropriate profit, like 15 to 20%, and it's just 70%. So why the sponsor will invest in that project? So they will avoid to invest that projects, the infrastructure projects. So in such projects, the government will grant the viability gap funding. So the government, if suppose the project cost is 100 rupees, so government will give the 20 rupees for that the sponsor, and that will not repayment by the sponsor, and in that case the sponsor will need to only pay the 80 rupees for the projects, and that will increase the revenue for the sponsor, that will increase the minimum life of the all amount coverage of the project cost, and they will generate the more revenue, and the sponsor will get interested in that project, and the project will get successfully. Then in that case, the predictability and the bankability is will increases. So the bankability things is the guys where the project is the technical viable and the financial technically feasible, and the technically viable and the financial feasible. So that's the thing we do in the bankability, technical viable and the financial feasible. So let's discuss on the cost estimation. What are the different things we are going to estimate the cost? We think the cost, how much that required for that project. So first one is the engineering procurement and the construction contract. So what types of that contract? It is a fixed price, or the floating rate price, or the fixed duration, or the fixed construction time. So that need to be considered. Then the interest duration contract. So interest during the construction, IDC, interest during the construction. We know that the duration of the infrastructure project is a long, and in that in that duration, the sponsor will not generate single amount of the rupees as the revenue. So in that case, the project the lender or the NaBFID will give the interest during the construction period, the bullion things will utilize in that thing. So in the construction period they will collect the minimum interest rate or the minimum in that the construction period. Once the construction is over and the cash flow will generated, cash is generated, so in that case they will increase principal amount and the interest coverage, interest rate in that case. So escalation contingencies will done, and the cost overrun is the NPA for the region once the cash is heavily run on that project. So that is a most and important reason for the projects that will be the cost overrun and the NPA will definitely happens in that project. So that need to be identified for the senior analyst and verify and update immediately on their the credit appraisal note or the notes or the documents which prepared by the analyst. Then the funding pattern. So there are the different kinds of funding pattern where the debt and equity are invested in that special purpose vehicle in that project. So in that typically funded pattern should look like in the ratio of debt to equity. So 70% of the debt and 30% of equity to 80% of debt or the 20% of equity is an upfront of that project. So thin equity and the higher risks. So the minimum equity and the higher the risk. The equity portion is increases, risk will be the minimizing, because if the sponsor will invest huge amount or the larger amount in that project, so he will think and he will continuously monitor, track that progress of the project, or he should make sure that how can I recover my investment as faster as possible. So that's why the thin equity is the the things. So there is a one key terms that is the skin in the game. So it is a most important term, and that definitely ask you in interview or the exam. So skin in the game means how much the portion, how much the amount that will be invested by the sponsor or the equity that will be invested by the sponsor in that project. So that is a skin in the game. How much the sponsor in that game. So the security packages. So we will need to understand, or the NaBFID team or the NaBFID senior analyst will need to understand that security packages in detail. So mortgage, trust and retention account, debt service reserve account, and the contract. So that should be there. The mortgage mortgage will be there. If there is a default will happen, how much the mortgage, how much the amount we are able to coverage, or the trust retention account is there. We need to track, use the waterfall mechanism on the trust or the escrow account. So in that waterfall mechanism, we need to give the funds for operation and maintenance first, or the tax and the speculatory review, and then we will give funds to the debt to equity, debt services. Then funds will utilize in the debt service coverage, debt service reserve account. Then that will be go the major maintenance coverage account, and then that will go to the any other operation and maintenance cost escalation account or the operation maintenance. And then the funds will spending, then they will go to the equity holders account, and the or that will be the store for the that itself in the project. So that's the waterfall mechanism will happen in that project, and the needed to the non recoursing of that project. So let's discuss on the key financial metrics, guys. These metrics are very important, guys. You should understand that matrix in detail and the 360-degree way. You should understand how that matrices will work, and why that matrix are important for the lenders. As the NaBFID, you are the lender. So debt service coverage ratio, DSCR. So debt service coverage ratio is basically the cash flow available for the debt service and the principal per interest rate. So debt service coverage ratio we will calculate for the monthly basis. Sorry, I'm wrong. The yearly basis we calculate the debt service coverage ratio. So in that year, what are the cash flows available for the debt service? So DFADS is stand for the cash flow available for the debt, debt flow available for the cash flow available for the debt service. So the cash flow available of debt service is nothing but the revenue or the cash flow are generated by that special purpose vehicle from that projects in the post construction, and what are the cost or what are the the operation cost, maintenance cost, statutory cost, liquidity cost, or all the cost that occurs in that projects minus from the revenue. So that will be the cash flow available for the debt service, and we will calculate the average cash flow if the tenure of that project is the 15 years. So the 15-year debt service coverage ratio we divided by the 15, and then we will go the average cash flow, and it will always be greater than 1.2x of the debt service coverage ratio, and the minimum of 1.10% in that entire 15 year. It should not below the 1.10% of that things of the cash flow of the debt service. So let's discuss on the loan life coverage ratio. Loan life coverage ratio, it is an also one of the important ratios, guys, and we need to calculate and we need to go through the loan life coverage ratio. So all the net present value of the cash flow available for the debt service of the loan tenure. So we calculated the net present value of all the cash flow available for that loan tenure and divided by the outstanding debt. What are the debt amount and what are the interest rate that need to be paid by the borrower? So that we calculated in the loan life coverage ratio, and it should be ideally greater than the 1.25x and show the questions over the life. So it is a good if it is a more than the 1.5x, and ideally the debt service coverage ratio is a minimum more, and below that more than that is a loan life coverage ratio, and more than that is a project life coverage ratio. So let's discuss on the next slide of another the core financial metrics that need to be understand by the NaBFIDs, or that need to be understand by the senior analyst. So the next is a project life coverage life coverage ratio, project life coverage ratio. So in that coverage ratio, it is a difference between the LLCR is that there is a we are going to add a tail period. So tail period is the period of where the sponsor has the ownership of that project, or sponsor is use that project revenues and generate the cash flows, but the life of that the debt will be the no there. So the all the principal and the interest rate will pay to the debt, and that project is used by the sponsor to generate the cash flow. So that is a tail period. So in that thing we consider the tail period is also so net NPV of the cash flow till the end of the projects, is till the end of the projects and outstanding debt. So in that thing we consider the debt investment and the equity investment. In the loan life coverage ratio we just consider it only for the debt portion, but the project life coverage ratio we consider for the debt and the equity investment, the total investment in that project. So then we discuss on the internal rate of return and the total equity to internal rate of return. So project internal rate of return in the total capital, how much the internal rate of return, how the profit will generated by the equity, because it is important. If there is a more profit in that project, so this project sponsor will more focus on that project and get finish that project. So in that case the NaBFID will easily recover their the principal and the interest from that this sponsor. So that's why they need to check the internal rate of return, and the NaBFID checks equity internal rate of returns for the 15 to 80% for the sponsor interest. So that's the NaBFID, that thing is also checked, because guys, if NaBFID will not think that part, so in that case if there is a no return for the from that project to the sponsor, so they are not going to interest in that project, and the project will get fails. It is the high chance that will get failed. So that's why that is important for NaBFID to check the internal rate of return and equity internal rate of return. So then let's move on the break even analysis, so where we are going to discuss on the traffic PLF. Traffic at which the minimum debt service coverage ratio is 1%, and the trace we consider in the break even analysis is a 10% revenue will drop minus the 10% revenue minus the 10% cost, or delay for that project is a 6 months to 12 months. So what is a break even analysis, what are the debt service coverage ratio, and what are the trace scenarios we are going to consider? In that all the scenario, debt service coverage ratio will not be minimum from 1 of x, that should be above 1 of x. So that is a good project, and that project we need to consider for the progress. So let's discuss on the next slide, guys, where we are going to discuss on the risk framework and the NaBFID lens. So where we are going to discuss all the risks and mitigated the NaBFID expects and the instruments that we need to cover or understand for that the risks. So let's discuss on the first risks, which is the completion risks. It is on the most important risks. We need to complete that projects on the commercial operation date or the date of commencement of the operations, uh, commencement commercial operation date. So the fixed price EPC contract LDC is there, sponsor undertaking is there. So NaBFID will check is the engineering procurement construction contract is a fixed price, operation and maintenance contract is a fixed price, land is acquired, and the sponsor is undertaking that project. How the sponsor, the scheme in the game is how much the sponsor, how the sponsor overview of that project. So that instrument is a cost overrun support and equity locking. So that will help the NaBFID will the cost overrun and equity, the NaBFIDs, and then the revenue and the market risks. It is also one of the risks that need to be tracked or verified by the NaBFID senior analyst. So annuity or the hybrid annuity model. Guys, currently the hybrid annuity model is most widely used in the market in the infrastructure project, where the 40% fund is from the government, and the 60% from the 60% portion is from the project sponsor, and some of from the lenders, some of the lenders. So these projects are the very good projects, and in that project the more the lender will involve and they will give the funds in such projects, hybrid annuity model projects. So the take or the pay kind of project. So once the complete the projects, take the projects and pay, and the regulated return will consider how the regulatory return will generate it, how the profit will generate it. So government is a counterparty. We consider that thing is the counterparty is government, or the escrow mechanism is there, and the trust retention account is there. How the process will happen. So that instrument we use or monitor the revenue and the market risk. So then another risk is the operation and maintenance risk, guys. It is also most of the important risks. So we need to check the experience of operation and maintenance contractor, what how much the projects they are involved, how they are the past experience, and how the successful they are in the operation and maintenance, and the performance bonuses or the bonds we need to check and identify and verify. Then the operation and maintenance reserve account we should have, where the funds we go store if there is some challenges or the problems that need to occur, and from there from the operation and maintenance reserve account they get funds and utilize in that projects and recover from their losses. So that need to be checked, and that instrument we will consider in that case. So let's move on the next slide, guys. Next risk, which is a regulatory and the policy, where we if suppose the change in law clauses and the concessions. So we need to identify while we are providing the funds to the borrowers. So what are, if there is in case, what are the change in law, how the project will impact it, what are the parts of the project will impact it, how much the interest and the principal we are going to recover from the borrower. So that need to be checked, and that need to be verified in that things, and the compensation mechanism from that the instrument that will help us the regulatory and policy things. So we need to verify and identify the combination and the mechanism instruments, and the interest rate risks. It is one of the most important risks, right, that will face by the lenders. So hedging will be the things that need to be used by to hedge the interest rates, the reset clauses, fixed rate option. They will use the fixed rate, not a floating rate, and the reset clauses or issue the bonds in the market. So NaBFID long-term fixed rate project is good for that, and identify the proper rate for the as compared to the market rates, or the refinancing risk. So takeout financing is a 25 years tenure. So it is under long-term financing, 25 years or the 30 years of the loan in the infrastructure financing. So refinancing, again, financing cost is involved, or the the lender will identify and then the finance that thing, and the tail period is a 3 to 4 years for the post date will occur. So that's the things we need to consider. So let's tail period is also one of the important instrument. So let's move on the next slide, guys, where we are going to discuss on the NaBFID specific nuances that are going into market, and you should understand that thing as the senior analyst or the analyst or the any stream you are going to interview for the NaBFID role. So the development mandate is one of the things. So escalated economic impact, the ECG, environmental, social, and governance. PM Gati Shakti sector. It is the one of the important thing that launched by the government or the Modi or the Nirmala Sitaraman, guys. And before going to interview, you should understand the what is the PM Gati Shakti, how it is the help to grow the infrastructure project beyond the pure commercial. In the PM Gati Shakti, there is a 27 plus ministries are come together and help to infrastructure project to grow and to to build the most and economical viable the infrastructure in the market. Suppose, guys, let suppose the pool is constructed on the rail. So in that case, the railway ministry approvals will needed. The rail will start. So in that case, rail will give us the 2 hours. In that 2 hours, you need to complete the tasks what we have, and then the rail all running. So it is a challenges. The rail are continuously going on from the that rail route, and the working which happen. There is an accident will happen. So that in that case, we need to approval from the rail ministry or the rails thing. So that's the PM Gati Shakti will help the ECG contract, environmental, social, and governance approvals, and all these things is a mandate in the development, and that need to be tracked, and that need to be that are the new enhancement for the NAP. So credit enhancement, it is and the most important thing though. NaBFID can provide the partial credit guarantee or the credit default swap to crowd in the lender. So they will enhance the credit of the borrowers, and they will give the can provide the credit guarantee on behalf of the borrowers to the different lenders. So then the long tenure and the sculpted repayment. So 20 to 25 years with bullying and match the repayment to project life cycle. So guys, what is a bullying, is important. So let me explain you the bullying things here, guys. So bullying is a situation, or it is the good for the borrowers in the infrastructure finance, guys. You in the period of the construction, there is no profitable thing. There is no the cash flow are generated from that project. So in that project, the sponsor or the lender need to be give some space, breathing space, or the interest during the construction breathing phase. So where in that case, the lender will take a minimum interest rate or the minimum repayment from the EMI from the project sponsor, but the project is get progresses, the revenue and the profit is generated. So in that case, the EMI value, the principal and the interest rate will increases how the progress of that project or how the cash flows, how the revenue will generated. So that's the effect, the bullying effect. So that's the important of bullying effect in infrastructure finance. So let's discuss on the takeout financing. So refinance post commercial operation debt from the bank at lower rates. Once the project is completed, cash flow is generated, that the commercial operation debt is passed, and that the project or that the project is used by the end user. They will pay for the taxes or the cash to using of that project. So then takeouting financing will happen, and the bank will lower the rate of interest in such kind of projects. So appraisal and the standard TEC, sector risk rating model, RBI norms, NaBFID acts or less. So we should always align with the RBI norms, sector related things. We need to understand the any notification or issue from the regulatory related to the infrastructure project that need to be utilized in the NaBFID environment. So let's move on the next slide, guys, where we are going to discuss on the senior analyst appraisal checklist. It is and the most important slides, guys, and you need to understand very well and detail these things. So due diligence, legal and land are the we need to check the legal things and land acquisition, how much the land is acquired. There is a recently NHA, National Highway Authority of India will I would say that we are going to the projects sponsor which have the at least 90% land. So that is the good initiative. Approvals from the environmental, governance, or the social, or the all other the regulatory bodies that need to be approved on that projects, or the tri-party agreement, so that need to be checked and verifying the due diligence, or the technical check, the DPR, lender independent engineer report, which is the most important report while doing the creating the post sanctions reports, or monitoring the post sanctions of that project progress, and the LTV, loan to value reports, and the financial model audit that need to be checked and that need to be verified. Then the model sanity. So in the model sanity, we are going to check the hard coding or the interest during the constructions. It is impacted on the bullying effect, or the circular clarity, tax, depreciation, debt service reserve account build up, and we check, and we have to keep mind the amount, the principal, and the interest rate in the debt service reserve account. We need to verify. Then we need to check the sensitivity analysis. We need to identify the sensitivity analysis and do the scenario analysis from each sensitivity point. So traffic is negative the 5%, 10%, or the 15% to check the debt service coverage ratio, how it is impacted, or delay in the 6 months or 12 months of that projects, what are the impact on that projects, or the interest rate will increase in the 100 basis point. They combine that and do the stress testing, scenario analysis, sensitivity analysis in that projects, and identify the conclusions how that project is success, and to identify the debt service coverage ratio, project life coverage ratio, or the loan life coverage ratio. Then the covenant is the terms and condition in that project. So need to check the cash swaps of the related to covenant, restricted payment, debt service coverage ratio triggers with the debt coverage ratio, and what are the mandatory repayments things, what are the closure of that project conditions will write in the covenant. So that how the payment or the escrow account or the transaction retention account will work, or what is the mechanism for the debt service reserve account will happening, and the post disbursement monitoring. So where we do the lender independent engineering report verification, track the lender engineering verification reports, and then the trust retention account early warning signals triggers, debt service coverage ratio, which should be not below the not less than the 1.5 1.1x, and the cost to overrun is not increasing the more than 10%. So do the scenario analysis and stress testing on that things also. So guys, this is the last slide where we are going to discuss on the red flag to escalate it immediately. So any red flags from which I am going to discuss in this slide, if that occurs, so you need to immediately escalate it, that project to the higher authority, and you need to prepare the PowerPoint presentation or the credit appraisal notes or the document which that NaBFID will want to prepare you for after the these red flags will happen. So we also call it as early warning signals. So the if suppose in that case debt service coverage ratio is less than 1.05x in the base case, or 1.1 in the downside, if that is happening, so you immediately do the red flags for that projects and update that projects to the higher management. So equity not infusion upfront. If the equity is not received from the project sponsor, and they don't maintain the debt to equity ratio, so you just this is and the eighth fight, and the promoter busy instant of the cash flows, and they will not give, and they want to do the scheme in the game. So that this is also one of the red flags. And weak termination payment clauses in the concession. So you need to go the concession agreement, you need to go the tri-party agreement, you need to go the power purchase agreement, you need to go the public private partnership agreement, and check the termination contract or the termination payment clauses, how the termination will happening, who are the owner in the case of the termination. So verify thoroughly in that things, and if that is not the appropriate, if that is not the right way, so it is and the red flag, and that need to be immediately highlighted. So no independent traffic study for tool road. So there is, you need to do the independent traffic study. You need to identify different traffic study and do or to check the assumptions of that traffic study. Is that assumptions are appropriate, or is that assumptions are marketable conditions. If that is not satisfied, you just need to do the red flag. In that case is also single point revenue risks without escrow. So it does not depend on the single point revenue without the escrow. We should have the escrow mechanism in the special purpose vehicle or the special purpose entity. We need to track that thing. We need to have the escrow mechanism or the debt service coverage ratio mechanism. And the tail period, guys. Tail period is a period in which the debt service coverage ratio we are it is the life of the projects minus the interest and principal recover from that this project sponsor. So there not the tail period is less than 2 year for the loan tenure. So what are the tenure of the loan? So that is not less than 2 years. So it is more than the 2 to 3 to 5 years. So that is the good, and that is not the red flat fact track in that the projects. So guys, this is the end of the very important topic. Is the basic of project finance, guys, and I'm very well explaining is the topic is the points, guys. You just need to study very hard, and best of luck for your next interview or the next job role in the development financial institution. Once again, guys, thank you so much for attending this interesting seminar. Thank you so much, guys. Please do like and subscribe my channel, guys.